choice.
Yeah,
What are the facts around that?
yeah. We'll hear often from financial advisors, buy term insurance and invest the difference. And they'll tell you that you can self-insure later in life. So if your term insurance does expire and you outlive it, you've got this nest egg of cash that you could use for self-insurance. Well, term insurance does have a lower premium. That's true. But term insurance could actually be the highest cost if you kept renewing your term policy every 10 or 20 years. Because if you renew 20 years from now, you're older, so the cost is going to be higher. And then if you renew that again 20 years later, the cost is going to be higher. And then you get into the ideas of, well, maybe I'm not insurable and I can't even have term insurance. So it does have a lower price, but the overall cost for term insurance could be more compared to if someone just purchased whole life. And think about this. If you have a term insurance policy, which is like renting that we talked about, when that expires, it puts a lot of pressure on a person's assets to perform because now their assets, 401ks, IRAs, brokerage accounts, real estate, whatever it might be, now become that person's life insurance for them. Where if they would have paid premiums to have a much larger death benefit, generally we want permanent insurance that isn't going to go away. So you do hear often out there from financial entertainers, buy term insurance, invest the difference, hoping you're going to make good returns. But in the market, we don't know what those returns will actually be or what a person will actually have. So term insurance is great, but we recommend term and a permanent insurance policy as well.
That's a really interesting point about putting pressure on other assets. And I really like what you said about the increase when you're renting, costs are always going to increase over time. And that's an interesting point versus locking in the costs, having them fixed, which I know you're going to probably touch on at some point. And then you're not worrying about it. You're not putting pressure on those other assets and you don't have those increasing costs over time, it sounds like.
Yeah, about 10 years ago, I had a client, he was a pilot with a term insurance policy. It was convertible to whole life, and he found out that he had cancer. So
Mm.
he was thinking, if I don't convert my term policy to whole life, my term policy is going to expire. He had about 3 years left on his term insurance policy. Well, now that he has this cancer diagnosis, he can't go out and get more life insurance. No one's going to insure him for that. So if he doesn't convert to whole life, but he keeps the term insurance policy going after the 3 years, because the 3 years was the time frame where the level cost stopped, his 11th year term premium, it was like 100x. So instead of paying $3,000 a year for the coverage, if he went past the level coverage time frame, it was like $30,000 or $40,000 a year. So can you keep your term insurance longer than the level term? You can, but the costs get exorbitant. I mean, it's just crazy, crazy high, which you probably wouldn't do unless you were on your deathbed, which goes
That's a,
back to the point of if you have whole life or permanent insurance, that death benefit's always with you, and there is not an increasing insurance cost.
yeah, and that's a textbook example of just relying on term insurance, and he would have been in trouble if that would have been all that he
Yeah,
had
that's
in that
right.
circumstance. And you really kind of killed two birds with one stone with those examples. The misconception number one being term insurance is always the best choice. Misconception number two being life insurance is way too expensive. Now we've got a little better picture from what you just said about term and how sometimes term is more expensive. What else can we say about the misconception that life insurance is just too expensive?
Yeah. Well, we want to define what's too expensive. I recently had a client pass away, 39 years old.
Hmm.
You know, premature death. It's tragic to his wife and his daughters, but it happens. So, what price would you put on the death benefit that his family is going to receive? Not too expensive. They're getting a lot more than what he paid for. So in that case, they probably would have paid double, triple, quadruple for it because the death benefit still would have been higher than what they paid for it.
Hmm.
The idea is we want to obviously help people with their goals, Steve, but too expensive is relative, right? If you can protect your family, cover a wife and children or spouse from a tragedy, especially a premature death. But then on the flip side, what about leaving a great legacy? What if you live a long time and you want to leave a legacy? The point is, we can set up these premium amounts for whatever you want as a client, right? You determine what you want to put into a policy. On the term insurance side, cover your life for human life value for 20 or 30 years, but then also have some permanent insurance. And the benefit of permanent insurance is we don't want to think about it as an expense because permanent insurance is growing cash value. We'll talk more about that. So it's an asset where there comes a point where you have as much cash value in the policy as you paid in premiums. So if you wanted to cancel the policy for whatever reason, which we don't recommend, but if you did, you get all your money back. So at that point, you say, well, what did it cost you? If you can get all your money back in a permanent life insurance policy, it didn't cost you anything. But if there's an equity component to that. So don't think of a life insurance premium as a cost. It's an investment in your family, but it can also be an investment in your future where we then can show you how to use that money for some tax-free income.
Great points. And I'm thinking about the pressure it relieves from your other assets to the point that you just brought up in that in addressing that last misconception.
Yeah, and Steve, you're an estate attorney, right? You've seen this in the real world. When someone loses term insurance and now there's pressure on those assets, they're looking at, well, how does this affect me for estate planning? How does this affect me for creditor protection? How does this affect me for legacy planning? Permanent life insurance is a huge asset to someone's portfolio in all those areas, not, let alone for banking or for tax-free income. But there's a component here that as an estate attorney that the benefits are off the charts when we're looking at permanent insurance and life insurance in general, how that really helps someone's estate and their family.
Right. And it goes to a misconception, what I know we're going to touch on in a little bit with regard to sort of the self-insuring idea and why that's a bad idea. But before we get there, misconception number three, then it kind of builds off the last one about being expensive. But there's a misconception around whole life insurance and that's always a bad investment. So what can we learn about that?
And we would recommend right here that people pause the video and go watch my debunking Dave Ramsey video about whole life insurance. So
Yeah.
many misconceptions. We don't have time to get into all those today. So go watch the Dave Ramsey
Yeah.
debunking
And
whole life.
we can put a link in the
Yeah,
description on
that'd be
that.
great. That'd be great. So whole life insurance as an investment doesn't seem too attractive. And if you're talking about traditional old style whole life that's built on a death benefit play, it is true that it may not be the best investment, but it's still much better than what Dave Ramsey says. What we like to do is structure a whole life policy correctly for cash value growth, where the investments can be 5 to 6% tax-free returns, and it depends on a person's age and their health, etc. But if you're earning a 5 to 6% tax-free return, that's like earning 8 or 9% in a stock market investment. But guess what? In a whole life policy, there is no volatility. You make money every year on an increasing compounding growth curve. So
Yeah.
we do look at it as an investment when the whole life policy is structured properly, because then not only are you growing money guaranteed and you have access to cash, but all that investment money, the growth, the gains, can come to a person tax free. You can take policy loans tax free, buy other assets. So the returns on a whole life policy, if done correctly, can outperform stock market investments. I've seen it in my 27 years. 8 out of 10, 9 out of 10 times, these whole life policies are outperforming stock
Mm.
market investments.
And I know that you even see that in illustrations, correct? Where you can see the ROR, you can see it improve over time. And I know you tell people a lot that that's the picture when you see that increasing ROR, that's for the entire period. So in other words,
Yeah.
if they're seeing 3, 4, 5%, then they're seeing that in retrospect from the entire time they've had the policy, which is pretty exciting when you look at those numbers.
That's right. And you might see that 3 to 4% in years 10 or 12 or 15, but then you might see 4, 5, 5.5% in years 20, 25, 30. And what that means is you would have earned 5 or 5.5% effectively that entire time, not just in that particular year. So it's a powerful tool. And I like to use the phrase that it's a guaranteed investment, because most investments, Steve, people know they're not guaranteed. You got money in the S&P 500 or crypto or even real estate. There are no guarantees there. These are guaranteed returns. It's a guaranteed investment that you're going to make money every year because you've got a guaranteed return. And then the insurance companies we use also pay a dividend.
And it's a contractual investment, which I sometimes like to point out is very different than a lot of other investments that way. So
Yeah, love that phrase.
yeah. So this next one's big. This is a big misconception. The insurance company keeps your cash value, and you may lose your cash, and the people get all freaked out about that. So what can we learn about that, Bear?
Yeah, you will hear from these financial entertainers, don't ever get a whole life policy because all your family will get upon your passing is the original death benefit. So if you purchase $100,000 of whole life insurance, but you end up with 50,000 of cash value and die, your family only gets the 100,000. That might be true in some old style policies with companies we don't even recommend. But what we do is we structure the policies so the death benefit is increasing. So in that same scenario, if the whole life death benefit's 100,000 and the cash value is 50,000, you might think, oh, my family's going to get 150. No, your family might get 250 or 300 or 400,000 in death benefit. We make it so it's a benefit. There's a huge benefit in increasing death benefit along with increasing cash value. And Steve, I've liked what you said in the past, that the cash value is a function of the growing death benefit. Do
Yeah.
people get the cash value and the death benefit? No, we can't say that. But what we can say is they get an increasing death benefit that most often is even much larger than what their cash value would be.
Mm-hmm. Right, Barry, because you've illustrated that. You've added the cash, you've added the base, and then you look at the actual death benefit exceeding that number, which is pretty exciting.
And I used real life illustrations in the Debunking Dave Ramsey video. Look at those illustrations. They're brand new. I used a traditional old style whole life. You see the death benefit growing. I used the new properly structured high cash value illustration. So there's two brand new illustrations in that video that prove my point, and very emphatically where the death benefit is much, much larger than what you would ever think, and completely dispels this misconception.
So when people look at their own numbers, they can look at a properly designed policy. I know you show people this all the time, seeing that increasing death benefit and how that cash value is fueling and funding the death benefit, which
That's
is
correct.
enough to dispel the misconception on this.
Yeah,
The
look at
next
your own numbers. Yeah.
Look at your own numbers. The next misconception, that this is probably my least favorite of all the misconceptions, honestly, is that is it's the and it's one for the pundits and entertainers. They love this one, that I can self-insure. As an estate planner, an attorney who's worked with clients and whatnot, that's just a very ludicrous idea, in my opinion. What's your opinion on it, Bear?
Self-insure, what a myth.
Mm,
And first off, why would a person self-insure? If you can pay an insurance company to take on risk for you and put, less money into that, why wouldn't you do that? So it
mm,
is a myth. And the idea is, if you get to retirement and you have no life insurance, we talked about this earlier, you've got 401ks, IRAs, brokerage accounts, real estate, a business, crypto, and no life insurance,
mm,
all of those assets, whether you like it or not, are your life insurance. And
right.
you would have paid dollar for that. So if you've got a 401k worth $1 million and you pass away, the $1 million goes to your family. maybe you put 500 or 700,000 into that and it grew to 1 million. Well, if you put those same premiums into a permanent whole life policy, you might have two, three, four, $5 million of life insurance coverage, much, much more than just the asset itself. So, can people self insure? Sure. But guess what? They would be selling themselves short and their family short because they wouldn't be leaving behind as much money.
And one phrase always comes to mind for me, and that's sort of fire sale. This idea that if you've got all this wealth tied up in assets and then you were to die, especially if you have taxes, but even if you don't, if you need liquidity for any number of reasons that can come up, you may have to have a fire sale of those assets. It's just not a good strategy for folks. And the flip side of that, leveraging and letting the insurance company take on some risk, and you get this liquidity, tax-free liquidity with a death benefit.
Yeah, and you're speaking to estate tax. We don't know what estate tax will be January of 2026. There's an expiration or reset that's going to happen. So
Yeah,
yes, if someone's net worth is over the estate tax limits, they might have to fire sell assets. And we've seen the negative repercussions of that in some very popular examples. But if you
yeah,
have life insurance death benefit and you're over the exemption, you can let the life insurance proceeds pay off the taxes and not have to fire sell assets and potentially lose money and harm the family legacy, etc. So
right.
self-insuring, we do not recommend. It's kind of like, well, I'm going to self-insure my car. Well, why would you do that? You're putting yourself, your family, and a whole lot of other people that you're driving around at risk because
Yep,
you're limited to what you have. You get car insurance, you get homeowners insurance because you put the risk on an insurance company. Take the risk off of yourself. We do the same thing with life insurance. Let an insurance company whose expertise it is to cover your life, let them take the risk.
and the fact of the matter is, just to add to what you just said, Barry, if people have, there could be other reasons why you would need to have a fire sale. Maybe you just need to split up all the proceeds among
Mhm.
the heirs, and they're not going to agree. Maybe they all don't want a portion of a piece of real estate, for example. Stocks may have to be sold for that reason. In particular, a business may have to be sold if it's not going to function coherently with all the heirs. So these are all reasons to have that extra liquidity for sure. And there are probably many more that you could come up with if we wanted to talk about it for a while. So the next misconception, and this one we touched on a little bit, but I think it's a standalone in and of itself, which has to do with the returns. A lot of people, especially more sophisticated investors, kind of think about their return on investment, and the misconception is often that the return on investment is too low compared to other kinds of investing. We already touched on this a little bit with the ROR, but what more can we learn about that?
Yeah, the idea of what do you have in your portfolio today, right? So, anyone listening, you're investing money, you're saving money. What do you have in your portfolio that's meeting the criteria of is it guaranteed? Is it liquid? Is it tax free? And 99% of you out there are going to say, I don't have that investment. I want it. I want guaranteed. I want liquid. I want tax free. Why don't I have it? It's because the stock market doesn't offer it. Your 401k doesn't offer it. The only place to get guaranteed, liquid, and tax free is permanent life insurance. That's it. So you want it, you got to go out and get it because your portfolio is missing it. And what we're saying is have an asset in your portfolio that meets that criteria. You don't have to put all your money into a permanent whole life policy. Keep money in the market, do your crypto, do your business, do your real estate investing, all those things, because true diversification would be different asset classes, not taking the advice of your financial advisor and buying different mutual funds. That's not true diversification. So this enhances someone's portfolio, Steve. Like, who doesn't want guaranteed liquid and tax free? That's huge. So this
Right.
adds an element to your portfolio that most people listening don't have. We're saying allocate some money towards this for more peace of mind and then the benefits. And frankly, we're only scratching the surface on the benefits today. There are
Yeah.
10 other benefits we could talk about with permanent whole life insurance.
And would it be a fair takeaway? In other words, to put in a nutshell what you just said, don't let return on investment as a standalone concern derail you from finding out more about the other advantages to using this asset.
Yeah, because someone's going to say, well, the S&P 500 has averaged 7% for 100 years. I've heard people say it's averaged 12% for 100 years. It
Right.
depends on what you're looking at specifically, but an average return doesn't mean that's what you earned every year, right? So let's hit the middle and say 10%. If you have a 10% average return, you didn't earn that every year. You might have earned 12 one year and 18 another year, but you might have lost 20 or 30% the following year. So when you look at that volatility back and forth, what we're saying is a whole life insurance policy is going to give you a consistent rate of return. There are never losing years. And when you compare a consistent guaranteed return to all of that market volatility, 8 to 10, 9 out of 10 times, people are still coming out ahead with a properly structured whole life policy. Still do your market investments. Look, if you're getting double digit returns somewhere, wonderful. We applaud you and say, keep that going. But this asset is going to mitigate some risk in your overall portfolio. So look, I've got stock market investments. I'm not telling people don't invest in the market, but be diversified so that you're hitting all those buckets: tax deferred, taxable, tax free, guaranteed, volatility, right? There's going to be different levels of your risk tolerance, what you want to invest in, what you feel good about. Most people want guaranteed, liquid, and tax free, and they don't have it. And if we look at the true returns, these policies are remarkable because you make money every year.
Fantastic there. So I wish we didn't have to dispel myths, but it's a battle for dollars. We've talked about this. We want people to have the facts, and we always encourage people to look at your own numbers. If you're thinking about this, there's one way to really know, and that's to connect with Barry, look at your own numbers. Really encourage people to watch the Dave Ramsey debunking video that Barry put together. It's not only will you be entertained, but you're going to get some great information there.
People should look at their own numbers. When you put your information into an illustration, you're determining how much premium you want to put into a policy. Again, it's a guaranteed investment, so don't think of it as a cost. But then I'm going to teach you how to use the policy to be your own bank. I'm going to show you how you can have tax-free income in the future. But yeah, take the next step and look at your own numbers.
Good stuff. And wherever you're watching, there'll be a link to access our Pro Client Guide page. Find Barry, schedule the one-on-one, watch some of our other videos and webinars to get education if this is something that's brand new to you. And with that, thanks so much for joining us today, and we'll see you in the next video.